Thought I hit go live. Okay. Hey everybody, we're here with the Holy Macro Show. I forget the name. We just got a real name for it recently. So exciting to talk to you guys about the market this week, man. There is so much stuff going on. Especially it's very interesting to look at the commodities complex compared to the market. I woke up today and I was like, man, I wonder what my portfolio looks like, and seeing like we were actually up, and I was like, that doesn't even make sense. So how am I up? And so I started to look at the commodities complex, which has moved back a little bit lately, but it's still kind of holding up a little bit. So if we look at the market, you see that number one, the Russell 2000 down over 4%. That's a huge move, coming nearly all the way back to the breakout point. Pretty wild move right there, coming down. That's got to be 9%, 10% from the top. That's a huge move in just a few days. And then the Nikkei was also another one that really stuck out to me, seeing that. Well, let's just look at the 1 week performance. 1 week, the Nikkei is actually down the most, which is down almost 10%. The Russell 2000 in 1 week is
So
down.
the Nikkei today was the worst day since 1987.
Really? Yeah. I mean, it's a huge move in a 1 day move. What is it down? Let's see.
6%,
Six
something like that.
percent, yeah, just over 6%. The Russell 2000 down 4% a day. Crude down 3% a day, coming off of it was almost down nearly 4% earlier. The Nasdaq down 3% on the day. I mean, and this is back-to-back days of this type of magnitude, so it's pretty big moves down. If we look at the 1 week performance, the Nikkei is down 10%. The Russell 2000 down 7%. Cocoa's down 6%, surprising. Cocoa every day has been moving up or down 6%, so that's not really that surprising. Feeder cattle down 5%. Crude oil down 4%. The Nasdaq down 4% in a week. Lumber down 2.5%. So I mean, you're seeing these huge moves, and obviously the big winner and is the VIX, up 35% in the last week. The yen is up almost 5%. That's kind of very interesting, seeing it come off of that bottom and just bounce to that degree. The Swiss franc right behind that, up 3% on the week. So once again, we're seeing this major safe haven trade. And it was funny having this conversation, Kashab, the other day. And you've known me long enough that you actually will remember this time we traded through, which was 2019. And I was having this conversation today about the market movement and what it looked like. And I was like, well, you got to look at the last time we had rates high and we were, kind of getting into a tight liquidity market, and what happened after that. So if you do think, and we don't know, like, this is the thing that's the toss up here, is will the Fed react quick enough to make the things happen like what happened in 2019? The Fed came in pretty quickly. If I remember correctly, it was August. We had a bunch of chop. We were stuck in a channel of August, and then we broke out of that channel, and that was when the reverse repo happened. I think that was in September. So the reverse repo happened in September. They cut rates a little bit right around that point too, and we got a rally to year end, but this was a very safe haven driven rally. And Kashop will remember, like, I was talking about utilities and consumer staples, and people thought I was a psychopath because nobody talks about that stuff, but really it's like, those things are really important to kind of pay attention to in this market. So I think that we're seeing the safe haven trade kind of really take hold right now. Great time to be long bonds, man. Getting long bonds right across the curve before this was a savior for the portfolio, honestly. So we're long the euro dollar, which is the Fed rate, basically 3-month bonds, all the way down to the 30-year bonds at the moment. And those have been just jumping like crazy the last few days. Very interesting, because once again, it's kind of the opposite of what you and I saw in 2018, where the bonds started calling a bluff, and we started to it's exactly the same that we saw in 2018. Now that I remember it, right? It's the Fed, the bonds calling the Fed's bluff, and the bonds are still moving up as the Fed is kind of saying, hey, we're data dependent. We're waiting. I mean, that interview was ridiculous with Jay Powell. It was just data dependent, over and over again. And we know they're going to have to come in and cut it sometime soon, but it's interesting because it's always going to spook the market if they're not just completely clear cutting money, and infinity QE, whatever you guys need. So it's definitely an interesting market, but I think the playbook is more 2019. I think it's more late cycle environment. And with the VIX so low, Kevin and I have been talking about this VIX being down here, and I've been like, yeah, I'm bullish, but like it's scary to be bullish here. Like the VIX at 11 handle is pretty insane, and seeing it bounce all the way here, like most of the time, I mean, in the past couple of years, this was kind of the average for a while. The VIX would get to 15 and it would bounce to 20, and this would kind of happen over and over again. So now we're kind of seeing the opposite, but the cash VIX is above the VIX futures in the front month. So that's something to continue to pay attention to, but there's a lot of risk out there. So what are you guys seeing in the market?
Kashab,
Kevin, you want to go ahead? Okay.
Yeah, go ahead, Kashab.
I'm saying, so I think what's moving all this is the yen. And I've been talking about this for a while. So you had the BOJ do a pretty heavy intervention, and that's caused a massive sell-off. So to quickly recap the yen story, the currency has been depreciating for 10 straight years. So everyone's borrowed in the yen and used it to invest in foreign assets. So that way you get the double tailwind of whatever the asset price appreciation that you get, plus the tailwind of when you go repay your loans in the yen, it's cheaper. So in fact, there was this time somewhere around May where almost everyone on Instagram, so this is what my wife tells me, everyone on Instagram is going to Japan and buying Louis Vuitton and stuff because it's so much cheaper because the currency just went to 160. It was like dirt cheap or something compared to the European prices. So you had this big situation where the currency was at close to a 34-year low, and everyone was panicking because they thought the speculators, the whole George Soros trade where he broke the Bank of England. So everyone thought the speculators would succeed. 160, 162, it's going to go to 200, kaboom, like the entire Japanese economy is going to implode and it's going to be a crisis and they have too much debt. The debt to GDP is too high. So that was the talk that was going on. And what happened was the Bank of Japan said, hey guys, we are going to intervene. This is not going to go any higher. And the market kind of called their bluff and kept trying to short the yen, even though they said they're going to keep shorting it up. And ultimately, what we have seen is that the central bank has won. So now this comes with costs. So if you look at the topics, the bank index, you can see that some of the Japanese financials are down 10, 12, 15% today. And that's because they were the ones who facilitated this carry trade, this loan in the yen, and using it to buy foreign assets. So they facilitated this. So now that their counterparts are blowing up because of the move, you don't know what's going to happen to these banks. Will they get their money back? Will they be made whole? You don't know. Plus, what's happened is the Bank of Japan hiked its interest rate, and because of that, the stock market has been selling off. So now you have all kinds of leverage trades blowing up because the market did not take the Bank of Japan seriously. The market thought they could fight the central bank and win because one guy did that close to 30 years ago and he's a stuff of legend. So everyone thinks they can be the next George Soros and they keep trying to fight the central banks, whereas that's really not the way to do it. So what's happening is all these funds are now blowing up. Because they are blowing up, they are deleveraging, which is why it started with a sell-off in the Nikkei and the US tech stocks. It's now gone into a full-blown collapse where you can see, like today, you can see all the private equity firms start to go from all-time highs to down 10, 12%. So all the big guys, you can see a clear trend break. And let me just say here, so it's your birthday and happy birthday to you. I think you're going to see a lot of new trends, a lot of new trades that you can take just because of all the stuff that's happening. So I think this is a birthday you'll remember. And so anyway, so what we're seeing is the Bank of Japan has completely changed the dynamics in the entire world. And it's interesting, you mentioned the Swiss franc, you mentioned the safe havens. What's interesting is the euro has also caught a bid. So now what's happened is this has gone from speculators fighting the Bank of Japan to a currency crisis to a full-blown move away from the dollar. So you're seeing bond yields go down, the dollar go down, and you're seeing the euro pick up. You're seeing all the other currencies pick up. Sorry, not all the other currencies, but some of the other currencies pick up. And you're also seeing massive deflation in the commodity space. So if you look at your Aussie dollar, your New Zealand dollar, your Brazilian real, they all look pretty scary right now. So they are calling for deflation. And if you look at Mexico, so I consider Mexico, the peso, as kind of a trade on the industrials because of the given the sheer amount of manufacturing activity that happens in Mexico with goods getting shipped to the US. So the move in the peso, everything looks like, and especially the move in oil, because we are seeing a Middle Eastern crisis, and at the same time, oil is just going straight down. So putting it all together, it looks like the Bank of Japan has started a global deleveraging event. And the only way to kind of um make sure that it doesn't get into a full blown crisis is to have the Fed intervene. So this is an ongoing situation. Don't know how it plays out. Could turn out to be nothing because the Bank of Japan just says done. Whoever blows up, and then you get back to business as usual. Because we saw this around 2015, I think it was the Swiss franc defect from the euro. We had a big 1 day move in FX, but apart from that, there were no long-term consequences. So maybe it just morphs into that kind of situation where whoever needs to take the pain takes the pain, and then the world just moves on. Or maybe this leads to a bigger deleveraging event, then the Fed reacts, then the Treasury reacts. So just don't know how it's going to play out. But right now, I think everyone is deleveraging because there's just too much uncertainty, and that's why you're seeing the VIX spiking. You're seeing everyone who prepared for a low vol environment now preparing for a higher volatility environment. And that's a big change because the post COVID era, we have just never seen this kind of environment shift. Like you and I know, we have talked about the 2018 XIV blow up, which was the inverse VIX ETF. And within 5 days, it was all gone. It was a steady uptrend, and then all of a sudden it was done. So we have seen these volatility unwinds before, but a lot of traders, I think new traders, they started trading after 2020 and they haven't seen these events. So this is going to be a completely new environment. It's going to be completely different. And I'm actually quite excited to be trading through this because for the first time, it's not just AI or Max 7 or one of these bubble stocks, the tech stocks. It's the entire landscape is now tradable. Like you're seeing so many new trends start. You're seeing so many events, so many profitable opportunities. And everyone talks about the Russell in terms of small caps, but as someone who actively picks stocks, I'm seeing so many opportunities across the board to go long. And I'm just waiting for the price signals to confirm. Like so many value stocks are just in free fall. And I just want to buy these and hold them for the long term. I'm just waiting for the right time. So it's a pretty exciting time to be a trader, especially for my style of trading and for your style of trading. If someone's just trading the Max 7 or thinks tech goes up forever or buying call options, then that time is done. But I think for everyone else, this is the beginning of active outperforming passive. This is the beginning of the period where fund managers really earn their stripes, where everyone is going to want their funds actively managed because you need someone to handle these situations for you. So exciting times, and over to you, Kevin.
You put out a lot there, and I am 100% agreement. Now is where you see who can actually perform and who actually knows their stuff across the board, right? Instead of putting a dart at the board and somebody just pumping up random trades and everybody kind of crowding into the same trade. I don't know if that's over with entirely. That's always going to be an industry out there, but you definitely got to be a little bit more tactical. Fundamentals matter. Fundamentals now matter a little bit more than what they did in the past, right? We're right-sizing valuations in this market pretty much across almost every sector. And we're starting to see other sectors that did not get a lot of love. Now, I mean, man, I was on a space, really cool guys on there. I'm on a space and I had somebody that's been really focused on small caps come out and be like, oh, utilities look good here. And it's like, utilities have been looking good over the last 3 months. I mean, I'm not sure if you're late to the trade or not, but that is the normal structure, right? We had a conversation earlier this morning. The economics and the stuff that I've been talking about for last year, I'm sure everybody else has been talking about for last year, and the concerns that we had in some respects, it took a lot longer for them to play out, but they're still playing out. It still gives you confidence that cycles are still the same on a broad-based standpoint, right? Generally, you get these speculative pumps to the upside, right? A lot of cash was sitting on the sidelines. A lot of cash was in the pipes in general, fiscal spending, monetary, and it took a long time to kind of get that out. And now you're kind of seeing a scenario where valuations do matter. When you have an Amazon that says, hey, we are seeing a little bit of softening, boom, you're starting to see that stock correct a little bit more. And just because the time frame doesn't play out, I think the structure does. Late cycle behavior is consumer staples, utilities, maybe real estate, right? Where there's a CRE crisis. But even if you're looking at the real estate sector as a whole right now, still catching a bid. Interest rate sensitive. You're starting to see treasuries moving to the downside as far as rates, and equities moving down to the downside as far as rates. And Kashyap, maybe you want to throw this out there, or Jason. That's normal. A normalized market is when you have fear in the market. You have the VIX going up, obviously it's doing that today, and you have people going into treasuries. Why? Safe haven, especially right now. Treasury yields are looking pretty decent. And then you fade equities. When fear gets out of the market, what do? You fade your treasuries and you buy equities. That's normalized behavior. That's late cycle behavior that we're kind of transitioning late cycle behavior on the treasury curve into in the next couple of months, let's say 6 months or so, potentially starting in the early cycle behavior, right? And so I think that's also a very healthy trend, to say the least. Utilities doing really well. We talked about utilities about 2 weeks ago, 3 weeks ago, wrote about it in April, planning out fine. The prepper trade, right? The prepper trade is actually working out pretty well. And then, gold is pulling back. Gold is pulling back. But here's the thing. Gold's pulling back, but it's doing what it's supposed to do. In a part of your portfolio, gold is doing what it was supposed to do. It was supposed to protect you on the inflationary risk, the reflationary risk that was going up there. And then it's going to protect you with some form of uncertainty. Now, the dollar moving to the downside should theoretically be bullish for gold, but I think gold, from a technical standpoint, may have ran up a little bit too far, too fast. But even if it can hold its relative range right now and equities continue to slide, let's say that, it's doing its job. Silver, pulling back, it did its job for the purpose that we were kind of looking at. We were looking at silver in a situation where you have reflation, you got this reopening narrative happening in China, and then you also have precious metals. That was working for a part in time, and it's still actually at pretty decent levels. I mean, it hasn't really pulled back. I mean, it pulled back, but it hasn't broken that 29.5 or 28.5 level yet. It did what it had to do. So everything that goes into a portfolio when you're modeling these things out, you always have that diversification to help you out in times like this. And then when we are in bull markets, you have the exposure to tech and you have exposure to small caps. We're not there. We're not there right now. So I think we're in a good spot. I do believe the crude move is the right one. The only reason why we saw that pop was because of geopolitical risk. The geopolitical risk is not out of the question by any stretch of the imagination, especially if energy infrastructure is in play. So you keep your eye out on that for right now. But we did break through that 200-week moving average. We reclaimed it yesterday briefly, breaking through it now, trading at close to an area of support at $72.80. So look at that. If we do have a slowing, though, understand that crude can continue to move to the downside. But I still think that there's a geopolitical risk premium that is in place, especially over the weekend, because when you guys are seeing these type of tit for tat for Iran and Israel or Lebanon or Ukraine, Russia, that stuff, major escalations actually happen over the weekend, right? Not really during the week. They try to avoid the week as much as they possibly can. Now things happen, but there's still geopolitical risk that's out there. But overall, I think this is a healthy pullback. And like Kashyap said, I mean, now you maybe, right? Now you maybe are able to judge those that have been trying to advise you or those that have been advising you since COVID. Since COVID, you had a whole influx of money there. It was easy. Now it gets tactically a little bit hard. If you're forced to have open exposure to equities in the market, now you got to be very tactical with it. And I love that type of scenario. What do you think, Jason?
No, I agree. And I like this discussion because one, it's something that you and I talk about, Kashyap and I talk about. We talk about on these shows constantly, which is risk management, being smart about what you're doing in the market, diversification, all these things. The things, and I always say it sounds super boring. Nobody wants to talk about it. You don't want to talk about the fact that, hey, maybe you should put some of your money in money market. Maybe you should put some of your money in bonds. Maybe you should put some of your money in gold and silver outside of the market and diversify yourself for these type of scenarios. And just when you're trading badly, because that also happens too. So, all of these things can happen. So it's the more diversified you are with your assets, the better off you are. And as a trader, the more diversified you are, we got these buy signals in bonds earlier this week. We've been long the short end, basically the 3 month to the 5 year. Now we're long all the way across the curve, and it's really helped and hedged a lot of our downside in our other positions because our equity positions got hit. We went, but that's the point of having a trend style portfolio is that like you continue to take all of these trades. And what it looks like to me is, and just like you guys are seeing, it's the same thing where it's like we are running into this different environment. There's a lot of geopolitical risk out there, but that could be said a lot of different times. We remember in 2019, I think it was when I think it was Saudi Arabia. We had an attack on Saudi Arabia. At one point, we saw oil spike. I think it was the highest spike of the year at that point in 2019. And then it basically came right down and went down right after that. You had all the analysts calling for $100 oil again. It was just the wrong environment. And I think that's kind of where we're at here is like, we're going to see spikes in oil. But generally, I don't think this is a good environment for oil at the moment. I don't think this is a good environment for some of the commodities complex, especially the growth-based commodities like oil and copper. I do think things like gold could flourish in this environment because I don't think that we're in a situation where it's a deflationary collapse style environment. I don't see that just yet. I see that we're kind of running into safe havens. I see that trading has to be a little bit more tactical here. You can't sometimes when there's a commodity bull market like in 2020, 2021, you could spin around, throw a dart at any commodity, buy it, make a bunch of money. Very easy to make money in that type of environment. But when we get into these type of environments, it's going to thin out. You're going to want to be taking longs and shorts. We had the oil position. We put up our levels to go long or short on it. You're going to want to be going long and short. You're going to want to continue to be very tactical with your trading. You're going to want to understand risk management. Like all these things are really important. It's all great when everything's running straight up and you can just buy the NASDAQ and sit on your hands. But, what we've all been talking about for a long time is that trade has been so long in the tooth at the moment that at some point we're going to see the NASDAQ have this really bad reaction. And it finally did happen. It was a thin market. I don't think that this is the end of the bull run. But at the same time, I do say that we are later in the cycle than most people want to talk about right now.
Well, okay, so NASDAQ is in correction territory already, right? I think we're at 11%, 11.5%. Probably more than that now. S&P 500 is actually only off about 6.5%, 7%. So it still has a little bit more to go. Russell, I have no clue. Who cares? But so you could say, okay, Index completed a correction within a bull cycle, right? That flushes you out, and you can also say, okay, well then you could have a reset run to the upside. I agree with that. Technically, I mean, it does appear that we may have some more structural damage to the downside. We also have to kind of keep in mind too, NVIDIA earnings. What is that going to be? We already see the CapEx spend, and for the most part, it's been on trend, but we're not seeing that increase. We're not seeing the increase of the trend that we've seen in the past, right? We're starting to see a little bit more of a deceleration and a little bit more tactical nature when it comes to that spend. Does that hurt NVIDIA? Does it help NVIDIA? Who knows, right? But I think you're seeing a little bit of froth coming out of the market. risk reward, in my opinion, for crude is still decent for the next 2 weeks. Hear me out. For the next 2 weeks, until you get inflation data that comes out, for the next 2 weeks, you can still see another pop in crude. I don't think we have enough yet to say, okay. So when you're looking at that fundamental data, right? And we had the non-farm payrolls were god awful today. And I mean, that was something that was easy to be able to spot just based on the initial claims data that we've had over the last 6 weeks. I don't understand what the market was trying to price in 4.1% on unemployment. That wasn't going to happen at all. Until you get the deflationary prints for CPI, that's where you get a little bit concerned. We won't have that for another 2 weeks. I think that would be your nail in the coffin when it comes to energy. I'm not making a call, but here's the thing that I believe will occur though over the next couple of weeks. And unfortunately, I think that we will have a logistical issue, a supply chain issue in the market. I think that there will be a significant escalation between Israel and Iran and Iran, enough so that would cause spark fears in oil logistics. And I believe that will be your final squeeze. Oh, don't say that. I'm not making it up. I think that will be your final squeeze. There is the premium out there for is really understated when it comes to oil infrastructure in Iran being targeted, right? And it seems like Israel, and we're not getting into the politics here, right? But Israel has been popping off guys left and right. Seems like on like a day-by-day basis this week, right? That doesn't go unnoticed. I mean, you're going to see a reaction, and I think it's going to be actually a really significant one. You just had Jordan and Saudi Arabia. Was it Saudi Arabia? Saudi Arabia or Egypt? I'm sorry, guys. I'm getting them. I think it was Egypt. Jordan and Egypt, I think, just confirmed that they're not going to anything that goes over their airspace. They're shooting down, right? Going into Israel. I mean, that type of stuff there is like a powder keg. And I think that could be your final push. That's the only push you got because the macro data sucks, but that's your final push. I think it's going to be a logistical thing. I would also look at shipping companies too, would be another big play for that. And once again, I'm not saying like this is going to happen, but I feel like the balanced risk reward based on the situation that's happening right now, I think it's a little bit greater. The U.S. Came out and said yesterday that we're exploring additional U.S. defense options for Israel. I mean, what does that actually mean? Yeah, that's funny. What does that actually mean? So I think that is like probably the only bright spot that I see when it comes to the crude trade and comes to the energy trade right now. Grains technically look good. Let me say that again.
Sorry, Kevin, to cut you off. Sorry to cut you off, but before we move on from crude, so I have an observation. So during the Gulf War, what we actually saw was crude selling off when you had the start of the war, which was covered by CNN and all the networks. And I shared a photo here, if you can pull that up, Jason. So what we saw actually, the start of the Gulf War, crude went straight down. Which is something that no one expected. But it happened just because of the way positioning was so skewed. And since the Red Sea attack started, you have always had traders keep an eye on how this is going to impact crude. You have had hedge fund positioning swinging wildly from one direction to the other, from extremely bullish to extremely bearish. And with each report on inventory draws, especially US inventory draws or additions, you have seen once again, you're seeing this wild swing in positioning by the hedge funds, by the speculators. So what this has done is it is sort of hiding the fundamentals, meaning crude is moving more on sentiment than on fundamentals. So what you're seeing is just that. You have a war, you have the data, the tug from the US inventories, and you have something which is, if not deflationary, little less inflationary than what we have seen over the last few months. So all this is pulling crude, which makes it a little hard to trade right now. And even if it breaks those levels that you showed on this chart, I think we are going to see false breakouts, false breakdowns coming back into range. You're just going to see a lot more volatility in crude, which is going to make it a little hard to trade. So what I would do is I would look for proxies to crude rather than trade crude itself, because that is just so much easier. For instance, you pick a good oil E&P in the Permian, you pick something that's in the oil services sector. So you pick individual stocks. So I think something along those lines is it's going to be a little easier to trade than crude, because like we have seen with the Gulf War, like we have seen with the Aramco attacks, like we are seeing now with the Israel situation, crude is not going to be an easy trade during these times. And that's mainly because positioning is just swinging too wildly. So that's
Yeah.
my 2 cents there.
Yeah, actually, I think this is actually a pretty good discussion, if you don't mind. Look, so if I'm looking at managed money position, and I kind of talk about this a lot, you fade their moves, in my opinion. That has been a pretty decent and proven strategy for, I would say, probably the last 5 years, 6 years. And if you're kind of looking at the short position, just short exposure in general for managed money, it's the fourth or fifth largest short position for crude that we've seen in the last 2 years, 3 years, right? And every other time when we got to these levels is when we kind of saw a rebound in price. And the other 2 times that we've had higher short positioning was last week and the week before, right? I feel like, and I get what you're saying, right? They could compress it more. Producers could back off a little bit more. But if we're still in that backwardation and you still have that net short position, and it probably is actually increasing today as we speak, I feel like I always look at it from risk reward. I'm not saying like I feel like it should go up. I just feel like risk reward balance. I feel like there's a premium priced in that I think can still be had here. But I understand the macro side too. We're going to a macro slowdown, like crude will break down. And I think your crude breaking down to 65, that's my line in the sand. Like if it goes down to $65, then we got a problem. We got a bigger problem than what meets the eye right now. But if it holds up and tries to keep this technical structure at around 70, what did I say, 72 and a half, I still think that the risk is bad. I still think that it's balanced. Managed money has not been right on trading crude for the last 4 years, 5 years. And I'm going to hold to that they don't know what they're doing now. Managed money was calling for $100 crude a month and a half ago, 2 months ago. And it literally at the peak, that's when everybody was coming out and managed money was getting long. Boom, you fade that all day. And if we were not in a backwardation standpoint for crude, now that actually might change over the next couple of weeks if we do fail. But if we still stay in a backwardation, that's still ultimately going to give you a price lever to the upside here. I'm not calling a bomb because like the macro data sucks. Let me just be flat out. And hasn't been good for the last couple of months. We've been talking about it. Now people are actually starting to get concerned because it's now stagflationary. That's the concern. The concern's not recession. In my opinion, your concern is not recession. You would rather either have expansion. You'd rather be in this kind of nice little 2%, maybe 2.2% growth as we kind of go through this cycle, or you want a recession. You don't want stagflation. And that was stagflationary prints that we saw yesterday and even today. Initial claims hitting almost 250,000. And if we get 2 or 3 more prints of that of 245,000 or higher, you can bet your bottom dollar at a 4.3% unemployment rate right now. That bad boy is scooting up pretty decently. You're on the trajectory right now hitting 4. You're hitting 4.5. Maybe if you have the initial claims data continuing to map out, 4.5, 4.6%, probably by the end of by November. December, that's a problem. That gets you to the 100 basis point cuts by this year. I still think that's a stretch. I don't think that we should do that. And if we do cut 50 basis points to start off in September, you could kiss the equity market goodbye. That's gone. Your equity market's going to be pricing in a calamity, especially leading up to an election. That would be the wrong move for the Fed. But the fear, I think, is stagflation. Price is moving still to the upside or in expanding territory for ISM. ISM labor data, lowest that we've seen since COVID, ex-COVID out because that was an extraordinary event. Lowest levels since we've seen since March or May of 2009. Not great. labor, right? That's not great. When you're looking at inventory and new orders, similar type of trend, but prices are still sticky. So that's your problem. And if we do still have sticky prices, I still think that there's a commodity play to be made here. And once again, I feel like the last thing that we will have is going to be a logistical problem. It's not going to be a long one, but I think we'll have a logistical concern in this market that sparks up, I don't want to say all commodities, but a significant portion of them. And at that point, Fed can't do anything about it.
I think something to also say is something we've been talking about, which is, and I keep talking about my macro models, and they're in between regimes, and this has been over and over again. We continue to see that we're just stuck between these two different regimes, and it's every single day I look at it, and you do the data, every data report comes out, you pump it into it, and we're just between all of these regimes. And the one thing that we talked about the other week was most likely, here's the most likely scenario. And this is what we've been talking about for a while, which is the market's going to get into some turmoil in the summer, and the Fed's going to get behind the curve. And this is going to be disinflationary. We're going to see all these inflationary assets start to come down for a bit. And then most likely, the Fed will start to catch on. The Fed will start to cut rates, add liquidity, something will happen. Because globally, we're seeing it already. We know it's only a matter of time before the Fed just gets on board fully. They don't like to show their hand. They like to say words. I mean, God, that report, that interview with Powell was so bad. It just was data dependent over and over again.
Yeah.
And they just keep saying data dependent. And at some point they're going to say, okay, well, now we're going to cut rates, and it's just going to happen. So most likely they get behind the curve like they're doing. The market comes down a bit, everything comes down a bit. And then we get into that scenario where they're playing catch up, because that's just what they do. They naturally are always just a little bit behind the curve. And so I do think that this is, I think this is more short-lived than most people might want to believe. I don't think this is like, hey, we're heading into full-on recession. Hey, look for a 2008 style collapse.
Oh,
I think we're more heading into, some struggle. And like Kashop mentioned, these breakouts, these whipsaws, these pain trades, basically over and over again. Where you have to kind of be more of an active manager to make money. I think that's more likely. Kind of looking at the market too, like something I've been talking about a lot is I don't think the S&P is really going anywhere until we get to the election. When we get to the election, maybe then we'll see a good direction. Maybe then we'll see some upside. But most of the time, just naturally, what happens in the election season? Well, August is a little rough. September is extremely rough. October is also rough, and then the election happens, and usually we'll see some upside after that. So I feel like we're kind of running a very normal blueprint here. The only thing that's a little bit abnormal is sometimes we see a nice spike of the equities going higher into August for a little bit, and then it comes out. But once again, seasonality isn't perfect. Seasonality is this thing that kind of gives us a template. So for me, when I'm looking at it and going, well, September, October is usually when we see a volatility in the election season. It happening in August isn't that odd to me. That's kind of saying, okay, well, we were already at this crazy VIX handle of 11. We can't stay there forever. It's impossible to stay there forever. So at some point we're going to see a spike. It's going to jump 100% pretty quickly. And here we are, I looked at it a second ago. The VIX was at like a 29 on the cash VIX. I mean, it's very normal, but I do think one thing that I would like to say here is that I think this move, not saying the general trend or anything, this move itself, looking at the tick index, there's a lot of fear right now, and the fear has gotten a little crazy. So I don't doubt we see one of those weird Friday bounces today. And so speaking to you, Kevin, I know you watch these levels, and Kevin also put out a really great video. If you guys haven't seen it on his page, is that pinned to the top of your page, Kevin?
I believe so.
Nice.
Kind of.
But yeah, if it's not, you should, because everybody's checking it out right now. It's a really good video that Kevin put out on gamma levels. So what are you looking at level wise? And then we'll hop into Kashop and a little bit about NVIDIA.
For sure. I will pin that somewhere. I will find it. Okay, so yesterday, and you guys can go check me out, KG Bull and Bear. I think it's on there. Yeah. and you can check me out, KG Bull and Bear. So yesterday we were actually talking about these flows, and 5,400 was a key level, but I was like, hey, if we get below 5,380, that's going to be your sell-off problem. And when we opened up today, we had opened up below it, tested 5,380, and then moved to the downside here. Now we're kind of in negative gamma territory. We just bounced off the 5,300 level, and that's another key area. If we broke through 5,300, the next thing that we see is if 5,225, that would be a problem. That would be, I mean, we already have a problem right now, but that would be a very big problem, how quick and significant it is. Honestly, I don't have any upside levels. I mean, you kind of have to stair step them up. And the first one is the one is going to be 5,380 for today, which would mean that we would have to literally go all the way full circle, have a huge spike to the upside, which is possible. Because when you have a situation where everybody's flooding into puts, especially to start the day, and we hit a key area and everybody's like profitable on those puts, what are they going to try to do, right? They're going to sell those puts out. And so you can have this situation where market makers can are able to then buy back their futures contracts, and we have this like domino effect to the upside here. That could be a possibility. Who knows? And we're also on VIX Friday, or VIX Crush Friday, even though VIX is spiking this Friday. But there's also kind of be that kind of readjustment there. So I think, the downside move was definitely being priced in. The flows were definitely showing downside positioning was going to happen here today. Unfortunately, if we broke that level, and that's exactly what happened. One thing I will say though, we're not, but I believe we are having an economic slowdown. I don't know if we'll call it a recession yet, or if we will call it a recession. Usually recessions actually get classified after the fact. I think people got to understand. No one's going to come out and say like, oh, we're in a recession right now. You're going to have 6 months, 8 months, even a year later, somebody will come out and say, hey, okay, that was the technical definition of recession. So you don't know it. We're probably living through one and we don't know it yet. The data lags and all that stuff, right? Usually when we have major financial crisis, like the 2008 crisis, you kind of brought that up, like we are very conditioned to, I would say all of us here are very conditioned to that one, because growing up, we've experienced two major significant financial events, right? First one was 9/11, which was kind of crazy, and that kind of like scarred everybody, especially if you were like 11 or 12 at that point in time. And that's a kind of situation that happened. And then you have 2008. And not even considering COVID. I mean, COVID probably was a walk in the park for the millennials out there. We were like, oh yeah, we got another situation going on, like whatever. 2008 was a credit crisis, right? And then in 2001, we had 9/11 that occurred. But what also happened on the back of that was also a commodity. Well, when you're talking about gold, it was a commodity spike in gold that kind of caught everybody off guard, right? And that also had a little bit of an impact. You don't have those big recessionary events like a great financial crisis until you have a credit event. And I'm not trying to sound like the guy that says that you're effed all the time, right? I'm not trying to be that dude. But it is generally a credit event. An unforeseen credit event is usually what causes these bigger cycles. We had the regional banking crisis. For the most part, that's contained. Cutting rates will actually ease that pain. Real estate, we don't really have that much eyes into that because it's all private equity. So like we have a little bit of insight, but a lot of it's anecdotal until actually somebody goes under, right? Unfortunately, they can hide those losses. The carry trade one can be one, because Shop he's on something there, right? There could be a problem there, and there probably is a problem on the underlying here. Somebody. Let me say this: we have seen this for a year and a half. Kashap, tell me that wasn't on the radar for every single person for a year and a half. Somebody is going to mess up. SVB was the same thing. Literally, they're not going to cut, dude. They're not going to cut. And you're like, nope, double down. Somebody's going to mess up. It just depends on who. And who actually owns their underlying, right? Because that's how the credit events happen. That's going to be the biggest key for me. We don't have an event yet. I'm not saying 2008. But if there was going to be a likely thing that could tip the scales, is the unwinding of a trade that's been in place for the last 25 years of easy money and easy access to capital that now might be something a little bit different.
Yeah,
That's the case. That's the one. If we were going to say, hey, keep this on your radar, geopolitical risk, keep it on your radar. But unfortunately, we can't. The best thing that you can do is be very defensive during geopolitical risk. But the carry trade is literally in front of everybody, and it's been there for a while. And now let's see if that's actually if that unwind is gonna really burn people down or not.
So
No,
in
I
terms
love
of
that.
geopolitical,
I was just gonna
so
say
the
you guys were the first two people actually talking about it, so that's all I was gonna say. It was interesting because Shop's been on this for a long time. I saw Kevin wrote a piece on it. You know, it's a very important thing that nobody's talking about. Like people are kind of interested today because they're seeing the yen's very cheap. People want to buy it, but they don't know why. So understanding the why here is kind of the important part and what it means to the whole financial market. So go ahead, Kashal.
So the geopolitical risk, actually, it's not as big a deal as the carry trade, in my opinion, and that's because the physical traders, they are so used to seeing geopolitical risk. Financial market participants, especially new traders, not so much, but anyone who trades the physical commodities, anyone who actually works on behalf of the commercials, they have all seen this happen. They know how to price this risk in. And like we saw with copper when it went to $5, there was a short squeeze. So Trafigura, which was a physical trader, they got squeezed. So this stuff happens, but they have ways to deal with those risks. The problem with the carry trade unwind is it is impossible to figure out what the central bank will do. And until now, everyone's taken the Bank of Japan for granted. Everyone's taken this carry trade for granted. And even when they intervened, everyone thought it would be short lived. And everyone also thought so that US Treasury has a list of countries that they call currency manipulators. So everyone thought that Japan doesn't want to get back on that list, so they will temper their intervention. And none of those assumptions have held true. So now, when you have a move of this sort, and we are seeing when the market closes on Friday, we are going to see a lot of conversations happen, especially among the limited partners of the funds which are invested in private equity and venture capital. Because the Japanese money, if you remember the 1989 bubble, I think the top of the bubble was when Japanese investors bought a golf course in the US. I think they paid more than the asking price to buy an office tower in Chicago or something like that. Like I don't remember the specifics. So if someone actually knows the fact and can drop that in the comments, that would be great because it's a great story. So you saw those kind of moves at the top of the last bubble, and what you have seen is the Japanese have been big investors in pretty much everything globally. So my hometown has this annual conference where they call the Japanese and ask them to fund infrastructure. So Japanese are big players in the entire world debt and equity and real estate market. The exact size of this is not known, and it is not something that we will get to know until after the fact. It's just something that you kind of pick up when you're in the markets for a long time. So what we are seeing is something truly epic, truly hidden from the markets, because you're not going to see this in the indices. You're going to see this in every physical investment, every off the mark to market kind of investment. You're going to see this in terms of valuations. You're going to see this in terms of who are the counterparties. And of course, none of this will come to light until someone blows up. And even when someone blows up, you will not know how deep the problem goes.
Yes.
So if you go back to China with the Evergrande debt blow up, everyone thought one local developer protected by the CCP just went broke. And it was actually the rot was much deeper. And you just don't know with these kind of systems what happens until after the fact. And I think we really have to be prepared for something major to break. Like you don't know what's going to break, but if you just look at the price action in gold, it's clearly telling you that everyone is prepared for something to break. And even so, usually what happens is gold, when it's in a bull market, you see it kind of sell off on Friday, kind of sell off before US market opens on Monday, and then it picks up again. So we are seeing the same pattern, nothing very scary, and this is without the Western investors buying too much. So I think this is the first week where we have seen gold ETF experience some inflow. So maybe Kevin, you can talk about that. But overall, what we are seeing is investors are just not they don't understand the magnitude of the move. Just as going into 2008, you saw Bear Stearns fail, and people thought, okay, not a big deal. In fact, the market made a new high right after that. And then you saw the home builders have a huge rally going into the 2008 crisis, even though that was a sector that was very much in distress. And I think even when forgot which was the Bank of America Merrill Lynch, even during that forced merger, people weren't all that scared. It was the derivatives, it was the mortgage back, it was the implosion of AIG financial products that I think made everyone really scared. The implosion of Lehman Brothers, all those firms, just because of the interlocking structures. And with the move in the yen, you can bet there are Japanese banks, US banks, a lot of big hedge funds, and a lot of people who borrowed money to fund physical investments in other parts of the world. All of them are going to get caught, and probably a lot of swap trades are blown up, a lot of FX swaps are blown up. Like, you just don't know what's going to happen until something blows up. So I think the best thing to do here is follow the price action. Maybe look at shorting some of these private equity firms. Maybe look at shorting some of these tech companies, and then just wait for something to happen. Because if you go by the trend, if you go by the charts, you can also see that there's a clear, compelling case to be made to get short all these different stocks. So that's how I would look to play it.
Yeah, and I think the big question that you're kind of bringing up there, right, and that's similar to the financial crisis. We don't know what's been collateralized at all. There could be a whole thing of paper out there that we just don't know we don't know, right? And when we talk about that, we mean you get capital, you put it into a project, you issue paper to finance that project, somebody buys that paper, and lo and behold, that paper was financed by a carry trade, right? Like who knows that? And it's hard to re-rate that and reprice that. And when it comes to private equity, that's the shadow. That's the shadow that you don't hear until something blows up. Until somebody leaks something or something blows up, it's always going to be a mystery. Even the CRE situation is a mystery. It's not that we don't think that there's the problem there. There's definitely a problem. You can see with your own eyes. You go to Cali, you go to Chicago. I just came back from Chicago, man. I mean, like, the downtown is still, it still looks like the second week of reopening from COVID. It's not as populated, right? But you don't really know because there's a lot of private books that own that, and they don't have to disclose anything at this point. I mean, rarely they have to disclose anything. So I think you're spot on there. I think the collateralizing of those products could be something that you got to keep on your radar here in the near term. But y'all, I do have to jet. This is always fun. You guys are
Dude, thanks for coming on, man. This is a good conversation. I could have you and Kashab go back and forth for like 20 hours on here. It'd be great.
Yeah, we can nerd out all the time. Oh, actually, I did have a real quick question. Then I can jump. Kashab, what do you think? Because since you're talking about this and you brought up China and the housing market in a sense, what do you think about the rejection of the $1 trillion housing plan that the IMF put out there? So China, they had a $1 trillion housing rescue plan that they were trying to give China, and China declined it. And they said they're worried over moral hazards and bailout expectations leading to bad behavior in the future. What are your thoughts about that? And then that's one question. And two, I didn't know it was $1 trillion. That's a lot of money. $1 trillion is a boatload of money that you just decline. So what do you think?
So I think everyone should familiarize themselves with this book, Confessions of an Economic Hitman. It was written by a person called John Perkins who worked for the CIA, and he talks about how all these supranational entities work. So I was not aware of this IMF plan, but from what you say, it sounds like the IMF kind of offered China money with strings attached, which is exactly the playbook China uses when it goes to Europe or Africa and invests in ports and other infrastructure projects. So you get Chinese money with strings attached. And I think when the IMF told them to do the same, gave them the same option, they said, no, we would rather face our situation than take your money. And
We would rather crash
if you actually go back to what Iceland did during the 2008 financial crisis, it worked out perfectly for them. Like everyone thought the Iceland solution of just defaulting and getting out of the global financial system and facing the consequences was nuts. But fast forward, and if you look at Greece, you look at Portugal, you look at all the other countries versus the Iceland solution worked out perfectly. So maybe China is on the right track. Maybe some heads in the regional governments need to roll and then they clear out all the debts and they start afresh. Because so if you look at Chinese banks, I looked at them like a couple of years back, but you would see that they trade at point 0.1, point 0.2 times book. And that's mostly because all these problems have been priced in. Whereas if you pull up HDFC Bank or ICICI, which is the big Indian banks, they trade at multiples to book, which is insane. But that's kind of the situation here where everyone has rosy expectations of the Indian growth story and very, very low expectations on China. So if China does manage to clear out its debt, then it can start on a good trajectory. So I would say the one other thing. So over the last 100 years, the US economy has been the best in the world. And that's notwithstanding all the crisis that the US went through. So you had the 1921-22 crash, you had the Great Depression, then you had the post-World War economy, then you had the stagflationary 60s and 70s, and you had so many scary moments, both in terms of markets and the economy and the politics. And through all that, that economy was the best performer over 100 years. So I think when you put China in that context, them rejecting, and this is not that I do this as a market participant, it is that the CCP thinks they own the country, so they tend to think in terms of the long term. So you see the Silk Road, the One Belt, One Road initiative. So all the things that they have done, it's kind of a long term plan. I mean, I think China is the only country in the world which has bought a steel mill in Europe and shipped it part and parcel back to China to reassemble it. Like you do not do those kind of projects unless you have something really long term in mind. So what I'm seeing with China is if they have rejected the IMF loan, then they probably have a very, very good reason for it. And I would be very interested in figuring out ways to invest in China in the future. Maybe not right away, but sometime in the future. And what was the other question?
Oh, I just was wondering. Once again, just knowing the risk that they have with their housing market and them turning down $1 trillion, I think that would be that's interesting. But I understand the point that you're saying too, right? It's more long term strategic, and then also there's always going to be pork that's attached to certain things here. I don't know, man. I mean, when you're talking about like how did you eliminate the China debt? I mean, the CCP would have to take all of that privatized, bring it under their umbrella, which they could do. They've done that in the past. My thing is I don't understand why they haven't done that now. If that is the route that they wanted to go, you would think that they would have done that a year ago, right? Like they wouldn't probably wait until now, but maybe things have changed. Who knows?
Yeah.
All right, guys. I got a jet. Always great. I'll see you guys next week.
Great points, guys.
Okay.
Also, like we were talking about earlier, the bond market's starting to bounce a bit, so we'll see how those levels hold up. Make sure you check out Kevin's page. You do levels every day on Schwab Network too, so make sure to check that out. And then we'll see you soon, Kevin. Kevin and I are on Monday.
That's right. All right, see it.
So now let's turn it into a little bit. Kashab, you've been talking about NVIDIA for a long time. What are you seeing here? I just saw a recent post you talking about it. Kind of made us think about this headline, and I was like, man, I want to hear more about this. So what are you seeing, Kashab?
I think I think it's all tied to the yen situation. So, and that's because I made a thread on it. Maybe I'll share that in the comments. So what you have seen is SoftBank has been a big player in this entire tech rally in all the startup ecosystem, everything. So they have their hands across the whole pie when it comes to tech. And what you saw was 95 to 100% of the value of SoftBank is its stake in ARM Holdings. So what you saw was kind of both of the stocks moved in lockstep. and then ARM started to sell off. And it started to sell off because of the BOJ intervention. So now SoftBank has quite a lot of loans denominated in yen. It has invested in stocks and other investments across the world in all the other currencies. So they have a balance sheet problem. And even before the Bank of Japan's intervention, they had a balance sheet problem. So given this history, so when back in 2020, when the market was selling off, so what SoftBank did was they started buying a lot of call options. Now, because you're buying a lot of call options, the way the dealers manage, the people who write those options, the way they manage their positioning is when they sell calls, they get long the stock so that when the stock moves, they're kind of delta hedge. So when SoftBank started buying a lot of calls, dealers started buying a lot of stock. So this led to a lot of demand for the stock, which kickstarted a rally. Now, it's not proven. My hypothesis is during the 2023 bull market, SoftBank did the same thing. So they started buying a lot of call options, and then other people piled on, and then you had zero DTEs. So you had that entire frenzy going on, and everyone, as long as everyone was making money from it, it was fine. And then 2024 rolled along, and ARM shares started to skyrocket. So they had more money notionally to kickstart the rally a little longer. And it all works out as long as you have momentum. But when the fundamentals don't support, so I think the balance sheet value of that stock is probably like 5 billion, and it's trading at $150 billion, which is completely insane. So when you saw valuations get this out of whack, at some point the momentum reverses. And in this case, the momentum reversed hard along with the yen strengthening because of the Bank of Japan's actions. And this has led to kind of crisis in the tech space. Now, the good thing about a crisis is that it is in crisis that you, like, there's this famous Warren Buffett quote that it is when the tide goes out that you kind of see who is swimming naked. And it's the same thing with the tech industry. So once the tide went out, once the momentum faded, investors who blindly started buying tech because that's the index, you have to outperform your index, you're late, you have to catch up, all the other reasons, everyone took a pause and started looking at valuations again. They started looking at what's driven this rally. And what do you see? If you actually use any of these Meta Llama or ChatGPT or any of these products, frankly, they are not as good. And the usage has likely peaked. And all these companies, they are spending huge amounts of capex investing in this entire ecosystem. It, if you're old enough, it's like all the companies building these undersea cables during the dot-com bubble. So the level of capacity that was built out during that time. So internet usage has grown exponentially since 2000, but we are still not using the entire capacity of the network that was built out back then. So that's 24 years of all these undersea cables being a dead investment. So it's no different from China's ghost cities where they just build huge projects, entire cities, and no one lives in them. So that's wasted capex. And what investors are figuring out is the ultimate output of all these fancy sounding LLMs, Gen AI, all of this is just not worth the capex. And the capex is huge. And NVIDIA has been a big beneficiary of the capex. So what's happened is investors have looked at the entire ecosystem and they are saying, all the companies that spend so much on capex, they are not getting a good return, which is all the companies that gave money to Nvidia. So, which is like a Microsoft, like a Facebook, Tencent in China. So, all these companies, and there's a whole host of private operators, which I'll come to in a bit, which have also bought Nvidia's GPUs to set up their own data center. So, all these companies, they have built massive infrastructure, and they have either tried to lease it out and they have not been successful, or they have used it to create their own large language model, which has mostly turned out to be vaporware or just not as good. So now you have this on the one side, and then you have NVIDIA on the other, which is booking these record sales. So now when Nvidia is booking these record sales and showing these huge margins, and they kind of portray that they are the only provider of these chips. And what's happened is this has got the attention of regulators. So forget about what's happening with the Nvidia accounting. That's a separate story. What's happened is when you have a company which claims complete dominance over a new industry which has caught everyone's attention, this has also caught the regulators' attention. So it's the same situation Microsoft was in back in 1999 with the antitrust cases. So now you have all the regulators sniffing around NVIDIA's deals, and you have all these regulators asking questions of Amazon and Anthropic, which is another AI company. That so what happened was Amazon invested in an AI company and asked them to lease AWS credits, Amazon Web Services credits in return. So you have regulators scrutinizing these kind of transactions and asking, is this allowed? Is this legal? And so when regulators are sniffing around and investors are collectively, so they went mad in the crowd, which is a Charles Kindleberger saying, and they came back to their senses one by one. So once you see this bubble kind of burst, investors have figured out that they have to start asking questions. And I think the point where it all started was when ASML reported that they had a way to kill every single machine that they sold if Taiwan got invaded. So TSM woke up and said, why are we ordering these huge 300, $400 million machines if the person who sells it to us can just destroy it if they wish to? And that was when that part of the sector. So this is the early stage of the entire semiconductor ecosystem. So you have ASML, which sells the machines to the likes of TSM, which is Taiwan Semiconductors, which manufactures the chips that NVIDIA designs and sells to the people who run the data centers on which these large language models are trained. And the customers buy the output, the customers, which is someone like you or me, would buy the output of that by subscribing to Grok or one of these AI apps. So that's the entire ecosystem. So the first crack started to appear with ASML back in Q1. And then you had the cracks appear with Taiwan Semiconductor. And then slowly the whole bubble has burst. And everyone's starting to ask questions now. And Intel today announced that they are firing around 15,000 people. So here you have a dominant company which practically defined this industry. It's been around for 45, 50 years, and they are saying that demand is just not strong. So collectively, I think investors are starting to wake up and the regulators are starting to wake up. And the third component here is the accounting question. So NVIDIA, what they have done is they have reported tremendous revenue growth. And the way they have done this is, I'm just going to illustrate this with an example because that's the easiest way to do it. So let's say you're a company and investors reward you for showing lot of growth, lot of revenue growth. Doesn't matter what you do to achieve that growth, investors are just myopically focused on just the revenue growth numbers. So one thing you can do is start buying revenues. So this is what Cisco did during the dot-com bubble, where it's a simple math. If your shares trade at a PE of 30 and you buy a stock that has a PE of 20, and you can roll up those that company's revenues and earnings into years, then suddenly the multiple on that revenue goes from multiple on those earnings goes from 20 to 30. So that's a big win for you. So when Cisco grew during the dot-com bubble, what they did was they did a ton of such acquisitions. And as long as their stock had a higher PE than the company they were acquiring, it was a win for them because they got to show the earnings growth even though they were diluting shareholders. So with Nvidia, what they have done is they have bought revenues. And by buying revenues, what I mean is they have seeded equity investments in the AI space. And those companies, they have raised capital from outside investors, they have raised debt from outside investors, but all these companies that Nvidia has seeded, Nvidia has taken equity investments in, they have all turned right around and funneled their money into Nvidia. So what they have done is They have taken capital from Nvidia plus other investors, sure. So they've taken capital and they have plowed it right back into Nvidia. So when you look at Nvidia's accounts, what you could see is cash flow from investing activities show an outflow because they are investing in equity in other companies. And the revenue shows an inflow because whatever cash has gone out, that plus more has come right back in as revenue. Now, this is not illegal. This is, in fact, a very clever way of doing things. But NVIDIA has taken it kind of a little too far. So you have this situation, you have revenues coming in, you have investors rewarding that revenue growth, that is all fine. So now what happens on the customer end? The customer buys all these GPUs from NVIDIA, they plug it into data centers or they run data centers, so they need those chips. And then the end use for this is leasing out your capacity to the companies that want to build LLMs. But what these companies have done is lease some of that capacity right back to NVIDIA. So, what NVIDIA has done is it has purchased cloud credits or purchased time on the data centers on its own GPUs from the customers to which it has sold to. And this has created an off balance sheet obligation. So now you have a situation where if you look at the cash goes out from NVIDIA to the other companies as an equity investment, comes right back in as revenue, goes right back out as expenses in terms of cloud spending, R&D, whatever they want to call it, on these very same companies. Now, this is a neat little circle, and even this isn't illegal, but not disclosing what they have done is. So NVIDIA has strategic partners, preferred vendors whom it has taken stakes in, whom it is receiving money from, whom it is sending money to. It's kind of like if NVIDIA were to consolidate all these startups it has invested in into its balance sheet, the revenues would just disappear because it is just like the Kekule snake where one end of the snake is feeding on the other. So it's kind of that situation, just that it is allowed because these stakes are minority stakes. So technically, on an accounting standpoint, it is not a subsidiary, it is a separate company. But NVIDIA has failed to disclose all these deals because disclosing these deals would make it easy for investors to figure out what's happening. And once you disclose, so CoreWeave is one of the most well-known example. So they have given NVIDIA about $2.3 billion worth of sales, which was the exact amount by which NVIDIA beat the revenue guidance in the previous years, the same August quarter. So you have these kind of deals that are going on. The magnitude is huge, but the market doesn't wake up because they don't disclose all these transactions as, hey, we might have a conflict because we are doing so many deals with the same company. And just by not disclosing it, that's the fraud. The fraud is not in terms of you investing or you providing vendor financing, none of this, but not disclosing it in the filings is fraudulent. And I think it's a matter of time before the SEC wakes up, before investors wake up. And this fraud wouldn't have even come to light, but CoreWeave wants to do an IPO because it's outside investors. They want an exit, and the only way for them to get an exit is to dump shares on retail. So they missed their window. They were supposed to do it in the second half of 2024, but now the AI bubble has burst. So there's no telling how the CoreWeave shareholders will react. And this comes to the other part of the story. So you had all these companies which are helping NVIDIA facilitate this big revenue jump. And now all these companies, they can't raise any more money, they can't raise any more debt because the bubble has burst. What do the people who lent them the money do? So this is all private funding. So all the funding for these startups went from the venture capitalists and private equity. It went from the banks in terms of debt. So now you have this huge mess. And the way that mess gets cleaned up, I don't know how it's going to get cleaned up, but that's where the skeletons lie. So you can short the public company shares, but the real money is going to be made when someone figures out a way to short these specific deals. And I don't think one exists, but if there was something like that, then that would be the big short trade for 2024. It's not going to be you go and short the banks. That's not going to work. And it's not going to be you go short the tech space, which will work to an extent, but not to the same extent as the big short. This is going to be very different because all the skeletons, all the rot, all these deals, the shady deals, it all happened in the venture capitalist and private equity space. So we have to wait to see how it blows up. The beauty of venture capital private equity is there is no price. So if you and I we are running a fund, we have to mark our portfolios to market based on the closing price for this Friday. Whereas for these VCP funds, there is no such thing. They can just mark to whatever model. So you say that I'm going to change or tweak the assumptions in my model and come up with this number. And that's the number that I report as the value of my investment. So as long as they can keep that game going. So Cliff Asness, he wrote a paper calling it volatility laundering. And I think that's a beautiful term. And I think it needs to catch on. So all these PE firms, they have just, so CoreWeave is the best example because it's the most well known. So they just kept marking up the value of that investment, even though that company barely produces any revenue, has a ton of debt, and it holds depreciating inventory. So everyone who's even little aware of semiconductors knows we went from a giant chip shortage in 2021 to a huge surplus in 2022, where Micron, Nvidia, all these companies had to write down their inventory. And semiconductors have always been cyclical, where you go from huge booms to huge busts. It's the capex sector is always the sector of the any industry where you have these huge moves. So the players who have financed this, they haven't really taken into account the down part of the cycle. And I think that's just going to start now. So all this is going to make for a very interesting couple of years in the VCPE industry, especially the tech part of the VCPE industry. And it's going to make for a lot of news, but it's not directly shortable. That's the only problem here. So you can, the only way to play this is to short the stocks of these venture capital private equity companies, to short the tech stocks, and maybe go to cash or put on alternate trades like gold or bonds or just safe havens, a lot of other things. But this is it's going to be very different from the 2008 situation where it was the banks, it was the home builders, it was the entire construction related sector of the economy, it was all the travel. So you had people taking home equity lines of credit and doing a kitchen remodel, going on cruises, all the other expenses. So you had a broad slowdown in the entire economy because of the way the housing market was behaving. Whereas here, the situation is very different. So I don't really see what all the good trades would be, but this is just the framework that I have, and this is what I would be looking at when the situation evolves.
No, that's perfect. I will end it there. Thanks, guys, for joining us today. We covered a lot of topics: the market, we covered the short-term data, the long-term data, the safe haven trade. And if you guys just tuned in, we've been covering the NVIDIA, and you guys can basically follow Kashop. Kashop is always putting out great information on these big name stocks that people want to know what's going on inside of them. And there's a lot of things like price action is king because that's how we get paid, but that doesn't mean there's not a lot of things going on behind the curtain. So definitely check out Kashop's work. He's on Twitter. That's his Twitter handle right there. He's got a newsletter he's putting out there as well. So please subscribe to both of us. I'm at Against All Odds Research. Kashop's at his handle right there. So definitely follow the speakers, Kevin as well. And we'll see you guys soon. Probably next week. We're on every Friday at 11 a.m. and we're on Monday. And then Kashop also put it for YouTube subscribers. He's got his link right on there. So, all right, guys, we'll see you soon. We're on at 11 a.m. Eastern time on Mondays and 11 a.m. Eastern time on Fridays.
All right, everyone, and